Begin with the crisis at Indigo. It's far from over.
So markets have reacted, of course, to the fall in the rupee.
India has now surpassed Japan to become the world's
fourth largest economy in the world.
India is poised to become the world's
Fourth largest economy in the world.
What if the fastest growing major economy was a castle built on sand? For several years, stories have described India as the world's next economic superpower, a country whose growth has survived global slowdowns and where stock markets have seemingly infinite potential. But when you peel away the alluring numbers, you start to see cracks, rising debt, slowing investment, fragile jobs, and too much government spending. We're not looking for fantasies here, we're asking a serious question. Is the Indian economy approaching a hard crash? In the balance of the chapters to come, we will unravel the official statistics, talk about the developing pressures around inflation, external debt, and unemployment, and consider the conceivable outcomes that people in power don't want to consider. By the end of this chapter, you will likely have a firmer idea of what's hype, hope, and what's truly at risk in the world's largest democracy. Hold on to your hats. This will not be your run-of-the-mill feel-good common story. India's GDP growth is consistently praised at 6 to 7% a year, leading all other major economies, but growth rates can hide fragility. Manufacturing output has been weak, and small factories complain about slim profit margins and a lack of credit. Rural demand, representing over half the economy, is slowing, despite government welfare programs in place. Jobless growth is a term now being used to describe the economy millions of young Indians enter the workforce every year, but the creation of formal employment is lagging. The shocking headline number has been bolstered by government spending and consumption by households, which has been fueled by borrowing, not by a broad expansion in private behaviors. When consumption stops, or slows, the whole structure begins to shake. It is the discrepancies between GDP data and ordinary lived experience that gives economists pause that the miracle may be overstated for India without substantial growth in private investment and job creation. The economy's base will remain narrow, and it will be easily knocked over all at once when the big shocks inevitably come. Another potential source of instability is external vulnerability. India's external debt has quietly increased to just above $600 billion, and its current account deficit has continued to widen in times of rising oil prices. The rupee has been on a steady decline, having just reached a new record low against the dollar. Each time the rupee declines in value, imports of crude oil, fertilizers, and electronic goods become more expensive, which contributes to inflation at the same time as corporate balance sheets become increasingly stressed. At the same time, global trade winds are headwinds. U.S. protectionism is squeezing exports of textiles, pharmaceuticals, and services, as is a slowing Europe and increasingly tighter visa restrictions on Indian IT sector workers. Foreign institutional investors, who historically many exited the market at the first hint of trouble, pulling out billions of dollars in short order. It is, when these factors are put together, we see the seeds of a classic emerging market vulnerability: large financing requirements externally, volatile capital flows, and a weak currency. History has shown, combine these factors together and a downturn can quickly turn a slowdown into a crisis. Although core inflation indicators suggest moderate prices, food inflation is quite volatile, usually jumping to double digits with spell of monsoonal weather. Therefore, the Reserve Bank of India is at a crossroads over what to do with interest rates maintain high rates to defend the rupee and rein in inflation, or cut rates to stimulate growth and credit. High rates restrict small businesses' ability to borrow and reduces housing demand, while low rates could risk repeating the slide in the currency. Furthermore, shock pricing such as oil price runs and shipping constraints is transmitted directly into Indian prices. In a country where hundreds of millions exist on thin margins, price increases fundamentally reduce consumption. Policymakers literally are playing with fire. One wrong decision could stall growth or trigger more inflationary pressures. This policy space is narrow and leads to a more fragile system, especially when populist politics pushes for cheap loans and massive spending at the same time. Since the pandemic, government expenditure has sustained growth. Huge public works, hydrogen and diesel subsidies, cash transfers to the poor, and tax breaks. But the central government continues to have a fiscal deficit of around 6% of GDP, and many states are deep in the red. Interest payments on borrowings consume a large share of the budget and crowd out health, education, and research. Incomes falter because exports slow, or GST disappoints and the borrowing requirement balloons into a political crisis, while global interest rates stay high. Credit rating agencies start to suggest downgrades, making borrowing even more expensive. The result is a vicious cycle: more borrowing to sustain spending, and less room for stimulus in a downturn. When an external or domestic shock occurs, the government will find itself with little ammunition left to stabilize the economy. Private investment is the true engine of sustainable growth. However, India's investment ratio has stagnated. Headlines are generated by a few mega projects by conglomerates, but the backbone of jobs, small and medium enterprises, are struggling with compliance costs and lack of access to affordable credit. Youth unemployment remains at uncomfortable levels, and even graduates often find themselves in miserable paying informal jobs. Wage increases in most sectors has flatlined. Without rising incomes, there is no domestic demand for unattainable luxury goods, and without healthy demand, businesses will not invest in growth. Foreign direct investment continues to come, but cautiously, as investors are looking for clearer policy signals and fear the unpredictability of regulations. And this is where the so-called demographic dividend may turn into a demographic time bomb: millions of youth who have high buyer expectations in the absence of formal jobs. When this occurs, social tensions and political pressures will increase and must be managed carefully. If you look again, you'll see the dashboard flashing more than one warning at a time. Rural distress continues to endure despite record food grain production and headline announcements of record harvests. In many rural areas, wages have stagnated and forced family members to borrow to maintain their basic consumption. Debt in households, as a share of income, has increased sharply, not because they are taking on new productive loans, but because they are filling holes in their daily budgets. Corporate leverage, which appeared healthier following the last cleanup of banking, is already ticking up again in politically sensitive and/or capital-intensive sectors. To compound all of this is a global backdrop of tightening financial conditions, where, for example, foreign investors are asking for more and more risk premium in order to hold emerging market assets. Each of these factors on their own is perfectly manageable. However, once you start stacking these factors together with a rupee downside, oil price spike, drought year, or global recession, that is when you can suddenly have the elements for a sudden stop: freezing capital inflows, collapsing currency, and interest rate rising. This is the classic route from optimism to crisis in emerging markets. Crashes rarely send early invitations. They brew quietly, compound invisibly, and then break loudly, catching even seasoned policymakers off guard and leaving ordinary households to pay the price. To be fair, India has its strengths. India may have seen foreign exchange reserves drop from peak levels, but they are still some of the largest reserves in the world. A large domestic market can act as a cushion against export shocks. After several years of recapitalization and tighter regulation, the banking system is in a better state than 10 years ago. Digital infrastructure and fintech are bringing the formal economy to millions of residents, expanding tax bases and financial inclusion. If the monsoons are good and global events stabilize, India can continue to grow at 6% plus without a crash. Many believe that if conditions deteriorate, the government and RBI would respond aggressively with reserves, tariff adjustments, and targeted stimulus. These buffer stocks do not mean the country will not experience some pain, but they do buy the country time. The question is whether the policymakers will use that time well or squander it on optics and fixing short-term issues. Imagine the downside: the rupee drops sharply, fuel and food prices surge, and inflation erodes household budgets while savings lose value. Consumption collapses, and with it, the small businesses that depend on daily cash flow. Private investment freezes, government borrowing costs spike, and some highly leveraged corporations default, setting off chain reactions across banks and shadow banks. Unemployment rises not just in factories, but in the service sector too, and social unrest begins to grow. Investor confidence collapses, triggering capital flight and draining reserves at an alarming pace. In such a scenario, India might have to slam interest rates higher, impose temporary import controls, cut spending, or even seek external assistance to stabilize the currency. It's a low probability but high impact outcome. Yet, precisely because the stakes are so high, policymakers need to treat the warning signs seriously now, not after the fact. History from Latin America to Southeast Asia shows that waiting until the crash makes recovery costlier and slower, prolonging hardship for ordinary citizens and eroding political legitimacy at the very moment strong leadership is most needed. The Indian economy has reached a key point. It can either go all in on structural reforms, reducing regulatory burdens for businesses, promoting micro-enterprises or the informal economy, investing in education and health, maintaining or improving social safety nets, or it can drift and rely on headline growth and short-term spending to mitigate the damage. The first path may not promise miracles, but it builds resilience. The second path will make us feel good with the optics until we have a shock and discover how fragile the economy is. For citizens, investors, and policymakers, distinguishing between the two paths is essential. Crashes don't just happen, and miracles don't just happen. It's a collection of decisions on both sides. India's next decade will be defined by whether it can move from short spells of consumption-led activity to sustainable, productivity-led growth, and whether decision-makers can make hard decisions regarding vested interest groups who may oppose reform. Ongoing investment in infrastructure, human capital, and institutional transparency can transform vulnerability into strength. But waiting too long and not making definitive choices will likely mean the country is locked into cycles of boom and bust. India remains one of the world's most dynamic economies, but dynamism isn't invincibility. Crashes don't announce themselves. They gather quietly until they break loudly. Whether India avoids that fate will depend on choices made now. If you like the video, hit the like button and subscribe for more deep dive analysis, and join the discussion below.